Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining me. And on tonight's program, it's a very special interview with Rudi Filapek-Vandyck, the founder of FN Arena. Now, I've interviewed Rudi for many years, probably over a decade of interviews, and I said to him, this has to be the greatest interview that we've ever done. It certainly proved to be the longest, and I really think it probably is up there as one of the greatest we've ever done. Rudi looks at all the big issues around investing, gives some great names or great companies that he likes right now. I think you'll find it very, very insightful, and you'll also get some really good ideas of companies that you might want to invest in. And then poor Rickard looks at defensive stocks and ETFs that play a defensive game. He defines them and looks at some of the big names that are defensive, and these defensive stocks do tend to pay good income and also don't jump around very much compared to those high growth stocks like tech stocks that recently have really plummeted after zooming higher in years gone by. And then we talked to Paul Miron of M Squared Capital to see what's going on in the property market and how badly might house prices fall. That's the show. Let's kick off now with what I think is one of the best interviews I've ever done with Rudi Filapek-Vandyck. Well, I said it in the introduction that this will be the greatest interview I've ever had with Rudi Filapek-Vandyck. And let me tell you, there have been some great ones in the past, but this will be the best. Rudi, no pressure. How you going, mate?
Well, there's two ways of seeing this. Either all my interviews previously were not that good, or I'm really under pressure now.
Yeah. Now, all our interviews in the past have been legendary. The feedback is always fantastic, and that's why we've got you here. But I think there's lots of good reasons to hope that we rise to the occasion, the very high jump bar I've set in making this the best we've ever done.
Well, I can but try to explain what's happening in markets, Peter. That might be a good start.
Let's kick off really big and macro, first of all. We saw an interesting inflation number in the US, which quite excited the US and also the bond markets. And you're a guy who doesn't ignore the bond markets. Is the bond market falling because of the better than expected inflation number, or because of recession fears, or a bit of both?
It's a bit of both. And in particular in Australia, and I've been of this view for quite a while, the bond market has priced in quite an aggressive path forward for the RBA. And while it's very popular in finance to say the bond market signals this or that, I have been of the view that we should ignore the bond market locally. It's way too aggressive, and I won't drink beer for a whole year if the RBA ends up tightening the way the bond market is pricing it in. So that shows my conviction, because I like beer.
And local
in the US, however,
local brewers don't have to worry, because I totally agree with you, but go on.
In the US, however, the aggressive path that is priced in will probably be matched with aggressive tightening by the Federal Reserve over there. The market is hoping for a flattening curve in the momentum of inflation, and we should see that, because inflation has been very, very steep in its growth last year, and we would all hope that it doesn't keep on rising at that speed. That is part of the story, and that is actually good news for equities, because if bond markets settle down, and at the very least don't have to keep rising, that gives breathing space for equities, and in a general sense. But it also gives breathing space to those segments of the market that have had it tough when bond yields were rising quite steeply. And we have to think about the so-called bond proxies. And in Australia, you would have to be thinking at stocks like a Stockland and a Goodman Group and a Charter Hall and the likes. And you also have the so-called defensive growth companies. And you can add the likes in of a Woolworths, for example, and an Amcor. And you also have the quality end of the market, and that traditionally trades on higher valuations. They've done it tough, while bond yields caused the devaluation of share markets. And so the likes of ResMed, Cochlear, CSL, REA Group, car sales, you name it, they all can look forward to some breathing space when bond markets settle down.
Yeah.
And that's, of course, there is still the other end of the story. We are tightening in a slowing economy, and that I think that yet has to have a significant impact on bond yields.
Yeah, and I should make it, because you were saying, well, you sound like you're saying bull markets, but you're saying a bull bond market. Is that what you were saying?
I don't think I mentioned the word. I was just talking bond markets.
Bond market,
but,
okay.
To
just in case people weren't hearing you properly.
To lift this interview towards the standard it needs to be.
Yeah.
I think for investors in equities, I think it's important to understand that the devaluation that's going on, the devaluation of equity that is happening, it is going through several phases. And in the first phase, we had some exuberance that needed to come out of the market. Yep. And the next thing we had to go to lower valuations, because bond yields higher means lower valuations for other assets. So we need to go through that process. So now we're moving into the next phase. And now we're going to get worried about global growth, and in particular about corporate margins and profits. And I've been writing about this for a few months now, and it's I think we will have a true confession season. My tongue is not cooperating here. True confession season ahead of the August reporting season. So we should be careful now that we don't own too many companies that look a little bit shaky when their operations are encountering some headwinds.
Yeah, and so we should explain to people confession season. Rudi probably is Catholic, so that's probably the reason why, because most Belgians are, I presume, but maybe I'm wrong. But the confession season is when companies actually come out before reporting and actually say, well, things haven't been going as well as we expected, and that can lead to a sell-off, can't it?
They literally say, dear market, I have sinned.
Okay.
And then they get punished.
Yeah, I think it's underlying your Catholicism, Rudi. But let's move on to other topics. And this is quite a religious topic. A lot of people love tech stocks, and they're praying for a comeback in tech stocks. And on my reckoning, a lot of really good tech companies have been excessively sold off. I do believe one of my favourite ones in the world, which I thought was overbashed, was Zoom. And the reason is, like, you and I are using Zoom right now. And I thought, this is a company of the future no matter what. We've got people wanting to work from home, that's Zoom. We've got people like me accessing great legendary stock pickers like you, or stock analysts like you. Zoom makes it really easy to do it. It means I can get CEOs really easily, where 5 years ago it would be very hard. So Zoom's got a real future. I thought it was belted up too far, and we saw last week, it was about a 22% rebound for that company. And there are Aussie companies, I think, in the same mould. What do you think is going to be needed for those Aussie tech companies to at least get back to a fair value, considering their future?
Well, I underwrite your sentiment towards technology stocks in general, and it's good for people also to understand that what we've seen is probably the most severe sell-off for that sector since we had the Nasdaq meltdown in the year 2000, and this time it went much quicker. Yeah. So what the market essentially has done, it has cast aside all those companies that were of low quality, no earnings, a big promise, but not really good in execution, and probably not really a profitable future. And you've seen a lot of those stocks going down by 70, 80, 90%, and sometimes it doesn't even stop there. Next, up are the companies that are not profitable, but they do have a decent business model, and they're actually generating enough free cash flow. And we have companies in the market like a NextCC and a Zero in Australia. I mean, a lot of investors don't want to go there because those companies officially are not profitable, but they generate enough cash out of their business model, and they have a bright future ahead of them.
And they're growers,
they don't
aren't
have
they,
to come to the market. And
they are growers.
Yeah, absolutely. They are still putting in the numbers 20, 30, 40, 50, 60%. Where other companies can only dream of. And then you have another category of stocks which I'm just waiting for them to regain that momentum again. And we have to realize that technology in itself is not necessarily carrying the label of technology. I mean, it can be healthcare, and it can be finance. I mean, is ComputerShare a technology company? I think it's a finance company, but for some reason, it's sometimes labeled in with the technology. And the same remarks can be made about ResMed, Cochlear, etc. Now, if you go to pure technology, well, you can also throw in Pro Medicus, for example, probably one of the most promising business models we have on the ASX. Always expensive, but it has come down a lot from the exuberance we saw from last year. And then of course we have the pure form of technology companies. We have the likes of Technology One, for example, which remains, in my view, one of the stocks that you can just really have in your portfolio and just let it sit there. And the problem with how the market operates is that at some point, everything that just smells and a little bit of technology gets thrown out with the bathwater. And we've seen that. And if a technology stock only came down by 30%, it actually did very well. And I'm having a few in mind here, but I am convinced that those high quality companies in the local technology sector, and we're thinking Technology One, but we're also thinking Pro Medicus, and we're thinking WiseTech Global and Zero and NextCC, which essentially is not a technology company, but it's labeled as such. I'm convinced that those business models have a lot more growth ahead of them, and we're talking probably a decade and longer. It's just that when bond yields are rising, share market investors don't want to go there, and there is generally a fear of catching a falling knife. And once the bond market can settle down, we can all get a little bit more comfortable with the outlook for inflation and for valuations. Then all of a sudden you will find that, in particular, the quality end at first will see buyers stepping in, and of course, some of those companies that I've mentioned, the likes of Pro Medicus and the Technology One, I don't think they have to be particularly fearful of a potential recession that might be around the corner. Just to throw in a statistic of one of the companies I know very well, Technology One recently reported their financial numbers, and the churn in the customer base was as low as it's ever been. It was about 0.01%. Imagine that one. I think from memory it was 0.09. But anyway, it is so low that the business deserves to trade on a premium, and it should not be worried about potentially a slowdown in the economy and maybe worse in economies like the UK and Europe.
Rudi, I'm suspecting that there's going to be a lot of M&A activity once the worst or fears around interest rates, all those things that were settled down. And we saw last week there was the odd one around Appen, which Appen shareholders were praying for. It lasted one day. But like a company like Pushpay is another one that's been attention. But I also think companies like Zip and Tyro must be, why aren't banks even thinking about, these are so cheap now, and they've got big strangleholds in areas where banks haven't got strangleholds. They look such like good value to me, but are you suspecting that some of these tech stocks will become targets of takeovers?
I'm not so sure about the buy now, pay later sector, to be honest, Peter. But if for technology in general, absolutely. And you see that also. Just to throw in another one, Infomedia has also received a takeover bid. It wasn't that long ago that Altium got a takeover bid, which also disappeared quite quickly. I mean, maybe you're right. Maybe you are right, or maybe I'm not, because I remember now that Ham Group is still selling their BNPL operations to Fahour and his business Latitude. So, but it will and that probably comes into that narrative as well. That while equity investors are at the moment very reticent to put a lot of money in that sector. Those who are in the sector, they know that there's bargains to be had.
And it seems to me, because banks have given up so many opportunities to make money because they've sold their wealth businesses and they want to be in banking. And you know, a company like Tyro effectively is a bank. By the way, we forget it is actually a bank, and it's in an area where most banks aren't. Combank is, because they actually bought Klarna, didn't they? Which of course is buy now, pay later. But they're all in that sort of space. So it makes sense that one day down the track, we might open up the newspapers or go to great websites and discover those news stories. Let's go to another one. But buy now, pay later. What do you think the future of this is going to be, Rudi? Big ones survive, little ones die?
Well, I've always thought that after the euphoria stage, we get consolidation. And to me, it was always obvious that you couldn't have 1,012 operators in that market, so to speak. The whole characteristic of technology and of finance ultimately means that you are being left with 3, 4, maybe 5 players that basically dominate that market. I mean, if you look at, for example, the credit card industry, you basically have 3 major players. That's it. I mean, there might be a few smaller ones here and there, but they don't really count, and we don't really know about them. And a sector like car manufacturers probably have ultimately going towards a smaller group of players as well. They already have been consolidating a lot over the past decade. A sector like buy now, pay later, past the euphoria stage, it will be left with a few players, and then of course the race is on to decide which players will that be. I mean, I think that's the reason why Block, nowadays called Block, used to be called Square, why they went for the #1 player in that market, because all of a sudden they have a high chance of being left over with a big market share as one of the survivors. The challenge for the smaller players will be how much market share can they grab before the big players move in. And the banks, I mean, they may not have been eager so far to buy some of those players, but most of the banks around the world are sort of looking into launching their own competing products.
And NAB's done it this week.
And maybe that's also part of how that sector will consolidate.
Let's go to Asia for a moment. We know that President Xi decided he wanted to pick on tech stocks, and they got clobbered. He's kind of backing off now, and he also needs to get his economy growing. And some people asked me during that period where Asian stocks, you know, the Tencents, the Beidus, the ones that have done really well for a long time. People would often ask me, you know, should I buy an ETF, you know, like Asia or one of those for an eventual rebound of Asian stocks? And emerging economies actually, you know, do well, don't they, in certain phases? Well, do you have a view on Asian stocks, Rudi?
My favorite saying about emerging markets, and I have to say I have not come up with this myself, but emerging markets are markets for which you cannot emerge in an emergency. So the risk profile is higher for emerging markets. I mean, I'm someone who spends a lot of time and attention to governance. And from many years of experience, even when I was overseas, I can tell you that governments in Asia is not the same as we are used to it in Australia and in more developed economies.
Governments and governments. governments and
Yes,
governance.
exactly. Yes,
Yeah.
exactly. And it's not, it's, I mean, I'm always a little bit cautious when there's a lot of opaque business going on and there's more happening beneath the surface than is supposed to see the sunlight. I do think that many investors have paid a high price for ignoring the higher risk profile of emerging markets, in particular by simply taking big stakes in technology companies that happen to be in China. There is a value to be had in a technology company in Australia or in the United States or in Europe, because at least they're well governed, and their governance is probably of a much higher level, and obviously the regulations are there as well. Although they should pay more tax, to be honest, but that's a different issue. So I'm usually more cautious, in particular now that we are moving into a global picture that looks tougher on profits and on equity markets. I'm more of the view that you reduce risk in this environment and you don't necessarily take on extra risk. We can always revisit those higher risk propositions at a later stage.
Okay, so on the subject of, there's risky, you've always had a view on good quality income stocks. What are your favourite good quality income stocks? For the scared investor out there watching, saying, Rudi, give me some safety.
Well, how about, I'm going to say a very obvious one. And I think in this environment, Telstra is an excellent defensive safe haven to put your money in. It doesn't mean that Telstra is immune from cost increases and from potentially a more hesitant consumer. But I do believe that if you add everything up, Telstra surely has to be on everyone's radar who wants a relatively safe dividend income plus franking, and they're not going to cut their dividend. That's almost a given. Maybe on the less known side, there is a REIT on the stock exchange called Waypoint REIT, and the company code is WPR. And
is that the one,
that's basically petrol stations.
Yeah, petrol stations, yeah.
Yes, petrol stations. And while petrol stations are under threat longer term, because we are moving towards electric vehicles and they will have to find a new future for themselves. The risk profile for Waypoint here looks very favorable because the share price has sold off on higher bond yields, but they're actually culling their asset base. So they're selling some of the least profitable, least attractive petrol stations, and they're handing back most of the money they're getting from that to shareholders. And on that basis, Waypoint should be considered a relatively lower risk, more attractive proposition at the share price where it is now, which looks, and that's just me, that this is analysts who cover the sector. They all think it's heavily undervalued here.
Okay, let's get to the big picture for those people who like to invest in ETFs. If they're thrill seekers, they might go for something like gear. So let's talk about where you think the market will be by Christmas time. When we get that Santa Claus rally that we often talk about, we're going to talk about something around Christmas time. Are you seeing a market rebound, not necessarily back to where we were, but certainly higher from the levels we're currently seeing?
Peter, the truth is I really don't know, and my worry is that while corporate profits at the index are probably poised to hold up relatively well in Australia, my worry is that we might see a sharp fall in profitability in the US, where profits have been quite oversized over the past 2 years. They had record margins until recently. And obviously record profit growth has basically translated into a much larger gains than we saw in Australia. My worry is that if things go off the rails in the United States over the next 2 quarters, let's say, that we won't be immune in Australia. So my worry is a bit that it won't be up to us and that we will get sold down in if they do, and that we won't be able to withstand the downward pressure. Having said so, if we take a view of, let's say, 16 months from here, maybe 18, 2 years, it's hard to see how many of the quality companies here are not great value on that horizon. The caveat, of course, is that share prices over the next 6 months or so, they can go lower. But I also believe that from current levels, if you look beyond that, share prices should perform well at least in the quality companies. I still have my doubts whether that will remain the case in the highly cyclical sectors. A lot of investors, of course, have sought refuge in the cyclical sectors, in particular in the energy sector in Australia, and in the banks and in iron ore producers. Very good dividend payers. We're going to see a record dividend again from BHP in August. But my worry for those segments of the markets are that if Europe, the UK, and potentially the United States go into a recession, or if, at the very least, a recession scare, I'm a little bit worried whether those sectors can hold up in Australia, the very cyclical sectors, because history suggests to me that ultimately very low economic growth, it doesn't have to go negative. It does translate into lower prices for oil, gas, iron ore, copper, nickel, you name it.
Yeah. We'll pray for that Ukraine war to stop, haven't we? But let's just go one last question. There's I think a person he would call a fan critic, if such a word exists, and his name's Anton, and he often says, Rudi always says CSL, but it's underperformed for 1 or 2 years. Do you think by the end of this year you'll be able to say, Anton, I told you so? Are you going to see CSL hovering towards 300?
I am inclined to say I buy Anton a beer if that's not the case.
Yeah. Okay.
I think the tougher the environment will become looking forward, the more a stock like CSL will shine in this market. Okay. And that's with conviction.
Yeah. Well, you've actually given us a lot of insights in this interview, Rudi, but one in particular, a lot of people may well have not known, that you have a great fascination with beer, and you've brought it up at least on 2 occasions in this interview, which is, if it's not our greatest interview, I think it's probably our longest. And thanks very much for your contribution.
My pleasure, Peter.
Rudi Filapek-Vandyck of FN Arena. Hello and welcome to Switzer TV. I'm Peter Switzer. And today we want to focus on investing in defensive stocks directly or else using ETFs. Paul, what is a defensive stock?
Well, let's start with the definition from Investopedia. This is a US definition, Peter, but let's go with it to start with. Yeah. Look, it's a stock that provides constant dividends and stable earnings regardless of the state of the overall market. So predictable income, predictable distributions, and you should get it depending whether the market goes up or down. They also look at it on the basis of where their products and their income is pretty reliable, so that they shouldn't be exposed, or they shouldn't have a huge volatility of earnings as you go through the various phases of the business cycle.
Yeah, and they're for really risk-averse investors, aren't they, Paul?
Yeah, look, people who want reliable income, perhaps not so much after capital growth. Doesn't mean you can't lose money on a defensive stock, but a fairly high degree of reliability and certainty. I've added to that definition a little bit. It's a bit US, and I think this is probably a little bit more suits the Australian market. The first part is around the industry and the activity they're engaged in. The second part is some quantitative measures. Most importantly, the business they're in has to be relatively immune to the economic cycle. So if the economy crashes, their earnings aren't going to crash as well. So you want them to be sort of pretty consistent. Doesn't matter whether we're through a boom or a bear economic cycle. Not to expose to other shocks or other exogenous factors. So often an insurance company, for example, you wouldn't...
Cyclone,
you could have some sort of big natural peril come out, and it may not be classified as a defensive stock because it simply cannot control
Yeah.
what happens. For the sales and revenue should be pretty reliable and steady,
Yeah.
right? Doesn't mean you don't want it increasing, but it should be pretty predictable, doesn't matter what happens, and not a price take. In other words, not dependent on someone else's price. So that rules out most of your resource companies who are just price takers and have no control on the actual amount of revenue they receive.
I always think about companies like Wesfarmers, particularly Woolworths and Coles, Paul. They're sort of companies where people turn up, even during a recession, the share price can fall a bit, but the revenues still keep coming through.
Yeah, people still have to buy their groceries and their milk and their detergents and all the other stuff they buy at those stores. So, and really not much changes. It doesn't really matter how strong the economy is.
Yeah.
But there are some quantitative measures that can be useful as well. The first one is a low beta. Now, beta of 1 means the stock basically goes up and down with the market. When the beta is above 1, it means it goes up more than the market and falls by more than the market as the market goes through its daily cycles. So less than 1 means it's less volatile than the market. Typically, they'll have an above average dividend, not always high dividends, but they'll pay more than the market or more than their competitors. Typically, they'll also have lower price earnings multiples, and they'll generally have lower gearing. So companies that are highly geared often aren't considered to be defensive stocks.
Okay, so let's go and look at some classic examples.
Yeah, and these are really drawn from 5 or 6 sectors. Now, there are 11 sectors, and you'll notice that there are no materials, no energy companies, and really no one from the consumer discretionary sector or the information technology.
Because they can be volatile.
Which can be volatile and aren't defensive. So let's go through the classic sectors. First of all, consumer staples, which is probably the most stable sector and where a lot of defensive stocks get drawn from. Names such as Woolworths, Coles and Endeavour Drinks. Utilities, those that aren't dependent upon the energy price. Companies like APA, which of course just transports gas through its pipe networks. Typically banks are not defensive stocks, and that's because, if you get a really bad economic downturn, their bad debt can blow out and there goes their dividend. And we saw that not so long ago when all the banks had to raise capital. We saw it in the COVID crash when they cut their dividends quite substantially and they had to protect their bottom lines. But a company like Medibank Private, which although it's involved in insurance, that's health insurance. You don't have massive, great big, natural perils risk. It's very predictable. That and a company like NBI and it's a competitor,
NIB.
NIB, it would probably be both considered to be defensive stocks. The industrials, I'm not talking about those that make things, it's more in the transport sector. A company like Transurban and its toll roads, Horizon, which hauls commodities. I'd say Telstra is probably meets the definition of a defensive stock. Very reliable.
People keep paying for their mobile phone no matter what.
Yeah, but the earnings are pretty stable. We're actually seeing a bit of growth, which is positive, but there hasn't been, a lot of movement on earnings. And then some others. I mentioned in consumer discretionary normally aren't considered to be defensive stocks, but the Lottery Corp, which has just recently spun off from Tabcorp, all the data shows that people still spend as much money on Keno and the lotteries as they do, whether it's a strong economy or a poor economy.
That's when they need it. Poor economy,
That's when they need it.
They need a win.
Maybe some of the property trusts, it would depend what they're involved in and how much debt they've got. Some of the companies have got really long-term leases, company like the Charter Hall Long WALE REIT. And InvoCare, which is of course involved in the funeral business, I classify that as pretty much a defensive stock.
It has been a good dividend payer in the past as well. Okay, let's look at the exchange traded funds approach to defensive stocks.
Yeah, now it's important to note here, Peter, these are not
classic defensive
stocks. And in fact, they're taking much bigger portfolios right across the board. And so they're going to have some stocks that aren't defensive. But overall, a lot of these funds are being set up to be less volatile, higher income, and naturally they're just a bit more defensive than perhaps just investing in the straight ETF that just mirrors the index. So this is why I've listed them, Peter, but they're just with that important caveat. In really 2 categories. One's in sort of the higher yield category and the second is sort of the lower volatility category. Let's go to the higher yield. We've got 2 different forms of it. We've got the passively managed ETFs. These are your classic ETF. Things like the Vanguard Australian Shares High Yield ETF. That tracks a special index that's been created of so-called stocks that pay above average market yields, but also have some other quality indicators, and so that's quite diversified. iShares has also got a product called Dividend Opportunities, IHD, and also one from ETF Securities under the code of ZYAU. Then there are the actively managed ones. This is where we've got fund managers actually trying to pick the stocks. And again, the same metric. They're looking at what they would describe as quality companies, good, reliable, predictable earnings, pay a high dividend, not too much gearing, and probably not as much market volatility. So things like the beta shares Martin Currie Real Income Fund, there's a dividend growth fund from Switzer and the E-Invest Income Generator Fund. And then we have a lower volatility fund, which is a special ETF that iShares has created that tracks a special index that's been set to basically pick companies that are less volatile. And you could argue that's a defensive way to take some exposure to the market. I guess the only other thing to point out with defensive stocks, Peter, is that you can still lose money on a defensive stock because capital prices still go up and down. They perhaps just don't go down as much when the market falls and necessarily up as much when the market rises.
Yes,
so,
right. And they offer compensation in the sense that because they pay higher income, you might lose some capital gain in the short term, which eventually comes back if it's a good quality fund or a good quality stock. But at the end of the day, you get that income along the way, which makes it a little bit more defensive than a pure growth play.
yeah, you don't want to be in a dividend trap. Dividend traps never come back, and so they're hopefully selecting those companies that will come back when they fall, because they can increase earnings and increase their dividends over time.
Yeah.
But certainly they're paying, it's fairly attractive, and there's not a lot of earnings growth, but the market won't be too hard on the way down and probably won't look at them with too much gusto on the way up.
That's right. That's some great insights there, mate. Thanks for joining us on Switzer TV. Well, I'm catching up with Paul Miron of a company called M Squared Capital. They're in the credit space at a time when interest rates are on the rise. So he's the right person to talk to. Great to see you, mate.
Thank you so much.
A lot of people out there are really worried about interest rate rises, fed by my mates in the media, and probably they've been fed by some economists who I think have gone to la-la land with their forecasts. What is your expectation about what interest rates might happen for the rest of 2022 and maybe rolling into early 2023?
Look, the forecasts in relation to inflation it all stems down from inflation.
Yep.
So if we can get inflation under control to the parameters where Reserve Bank is comfortable, then there's no need to increase interest rates to up to 3.6%, and that's what the financial markets are factoring into.
Is that within 2022 or within a year of when
those forecasts are within 12 months.
Yeah.
So to increase interest rate, the official cash rate to 3.6, you have to go really hard.
From 0.1 to
That's right.
3.6.
That's right.
We have to have ballistic inflation of like 1970s capacity where it got to about 18% or something.
Yeah, and the issue is that you can't really compare the Australian market to the US, for example.
Yeah.
Their inflation is a significant or much bigger problem as well. You've got wage inflation cutting through as well.
Yeah.
They had the second inflation figure coming out, which was only 0.2% difference between what they had on the previous quarter.
Yeah, slight fall.
That's right.
Yeah.
And the increase of money supply that they've had as a proportion to what we've done in Australia is significantly higher as well. I think I read somewhere that 42% of the entire money supply had been increased during COVID period. So that's extreme.
I know when I interviewed Michael Knox from Morgans, he made the point that when a US budget deficit blows out to that proportion, history kind of says that the dollar falls, but the US dollar is not falling at the moment, probably for a number of other reasons. Yeah. Okay, so it's your game to understand where interest rates are going, because ultimately people come to you, you offer higher interest rates than bank deposits because you're not as safe as bank deposits, as most things aren't. But where do you think interest rates are going? Because that's going to be important to not only borrowers in the future, also your business.
I wrote an article about 6 weeks ago, which I went into greater detail in relation to what our forecasts in relation to interest rates are and what impact it will have to house prices. Now, Peter Tulip and Trent Saunders have done a really great paper in 2019.
And they're RBA economists.
The RBA economists, which talks about the relationship of interest rates versus the difference in the interest rate versus property prices. The most interesting part of it is that if you have a 1% decrease in interest rates, it approximately impacts by appreciation of property price about 30%. So let's look at the reverse. So now we're going to be looking at the interest rates going up. Will it have the same impact? Now, our belief is that you have to look at some other variables, which are also commented in this paper as well. We do have a shortage of property. we have immigration kicking in,
Yeah.
which we haven't had for the last 2 years. And there are other variables as well, such as vacancy rates, which are now lower than they were pre-COVID.
Yeah, and rents are taking up.
And rents are going up.
Yeah.
So if you take all those into effect, I think the negative impact in relation to interest rates won't have the same mathematical impact to property
on house
prices.
Yeah.
So we have a conservative view, around 15%. But more importantly, even though that our view is conservative in relation to where we think property prices, investors into our fund are not impacted. So let's say that I'm wrong, because really a forecast is a forecast.
Yeah.
And they increase interest rates, call it 2.5% because inflation gets out of control, and property prices fall by 30%. Now the deals that we have done in our fund, and being an ex-banker myself, I look at worst case scenario.
Yeah.
I wake up in the morning thinking, even though I have and I'm confident in my forecast, what will happen if I'm wrong? So therefore, what we have done, normally we lend, and I'll try to explain this a bit more, we lend 75% against any particular asset that someone offers to us.
As collateral in case something goes wrong.
We are secured lenders. So once again, it's a control measure. So if a borrower borrows from us and they can't pay it back, what's our recourse? What's our security? So if in the current market, are we doing 75% geared transactions and offering it to our investors? The answer is no. We've actually pulled it back to around 60, 65. In case, if we do have a...
price will have to fall more than 35%
That's
before you might have to go and sell someone's property to get that money. Yeah.
And the reason why we need to do that is that people rely upon our asset class for consistent, regular income. Now, if they don't get consistent, regular income with asset preservation, then that is the whole reason why you invest with us, and people invest in our asset class. And I think it's quite important to say, with all of the volatility that you have in the current market, people should be looking at that portfolio and saying, is my diversification there? Do I have enough income in my portfolio to withstand an economic shock? Now, it's more probable now that we might have something, we don't know the timing of it, but it is probable that it could be this year, could be next year, or could be the following year. So it's about that revaluation from a risk perspective for investors all the time to see what they're invested in and how it works.
And I guess the important link and why you would do this analysis is that if you believe the 3.6% cash rate was a possibility, you then, using the tulip numbers, have a very big fall in house prices. And sure, you would temper it with the other factors, but still, it would worry you a lot in terms of what might happen to your business and the value of the collateral that sits behind these loans that you've made out there. Where does your confidence come from that CBA and Matt Common is more right than the doomsday view?
I'll tell you where the confidence is. Because if you look at affordability,
I think that was the question. I did want you to tell me that, but go on.
That's right. So if you look at affordability, I don't think that Reserve Bank has a lot of option in relation to increasing it beyond that particular point of time.
Yeah.
The negative Keynesian effect is that if you take out too much cash flow, after-tax cash flow, from households, then you'll have the reverse effect, which is we might be in the risk of a recession because businesses are not going to have as much turnover because people are withholding that money to pay their mortgage.
Yeah.
That extra spending is not going to be in the economy, and then we'll see a reversal of our great fortune of unemployment rate being under 4%. So I think it's a delicate balance, and I personally believe that even if there is pressure from inflation to increase interest rates, it will be done over a longer period of time, not necessarily in a 12-month period.
Yeah.
And I think the danger is for a lot of economists looking at the rest of the world and Australia is that we do have two very important aspects of my belief, is that they can cushion our downward risk in relation to needing to increase interest rates and inflation. One of them is that we got immigration. So Australia is very fortunate that we can increase immigration beyond 1.6. So before COVID, Australia net migration was second largest in the world. And that has a significant bearing in relation to as a hedge against certain inflation pressures. Second of all, we have an economy which is based on an inflation hedge, which is mining stocks. So I think those two elements puts us in a more favorable position in the midst of a particular sort of market event or over the next 2 or 3 years.
So I guess that also what would help your scenario come true would be, China gets out of lockdown as soon as possible. And I read today, June 1, they're talking about going out of lockdown, which would be great because that improves the supply chain problems, hopefully reducing inflation over the next, say, 3 to 6 months. And then on the flip side, if we can get some kind of peace between Russia and Ukraine, that would be another positive to bring oil prices down and other commodity prices, which also would be a big help for inflation, because it is the inflation fear that's driving these really big interest rate predictions.
Yeah, absolutely. Look, there is always, in any type of economy, there is always downward risk and upside risk as well. But I think the energy crisis playing out in Europe, I think, is overplayed in relation to inflation in Australia. So if petrol has gone up to $2 a litre, that's a one-off event. And yes, it will pass on to food and other items, but not necessarily it will be compounding. I think the other interesting aspect to inflation, and not a lot of people are talking about, is whether wages are anchored, or future expectation of prices are anchored or not. And I think that we haven't had inflation since the 1970s. So the problem will be is that if you're an employee and you demand a 5% increase in your wages every single year, that will spiral inflation. But if it's anchored, I don't think there will be such a issue as what everyone believes it will be.
And why do you say if it's anchored? What's the basis of believing that it is more likely to be anchored?
Well, because it all comes down to immigration. So if you do, it's a natural hedge. So if you bring in more able people who can actually do the work, then you're not going to be demanding the one-off increases that we have right now. So the
baristas on $95 an hour out of the coronavirus will go back to $55 an hour.
I was listening to, certain professions are making more money than, like anyway.
Not you, but other poor people.
That's right. But there are anomalies in the market at the moment which don't make any sense, and I think those, once they come out, we should get some balance there as well.
Okay. One last thing as an idea of fear or confidence in the market. Are you seeing lots of people prepared to go into alternative lending products like yours?
Absolutely. Look, the demand of what we do is increasing. Is because I'm an ex-banker myself, and I know internally from a bank, as soon as you see the property prices are decreasing, they also change their credit policy. So we're getting some fantastic opportunities, which are bank-grade clients coming to us, because we can understand the business, we can do it quickly, and it's not that much more expensive than what the bank is offering.
Okay, and is that therefore a reasonable indicator that there's still demand out there for money for business expansion purposes? Because most of your money goes, it's not for residential, it's for business expansion.
Absolutely.
It might be backed by a residential property because it's the collateral. So you're an indicator of demand for money for business expansion. And at the moment, you're not seeing any. We're not seeing any contraction or anything like that.
We're seeing very healthy, and the proposals that are coming to us are A-grade quality. So from that perspective, we don't see any issues there from the structural issue in relation to the economy.
And Paul, what about that same question from an investor perspective?
Look, our current investors enjoy the ability to choose the investment that they want, a specific loan that they want to invest in, which is a great benefit over some of our peers at the moment, because not everyone's risk profile is exactly the same. But for an example, we're offering 7% net return to investors that is paid monthly, and it's secured against A-grade quality, and the gearing of it is no more than 65%. So it is very attractive from an investor's perspective. Also, we've got 39 loans that are under management at the moment, and we have 0 arrears as well. So that actually shows the quality of what we're actually doing as well.
Yeah, okay. Well, that's a good piece of news about the market. Great stuff. Thanks for joining us. That's Paul Miron from M Square Capital. And that's the show for tonight. And always remember, we're not recommending any of the stocks or any of the companies that present on the program. They're people who are providing information, invariably with insights that most of us haven't got. But ultimately, you have to work out whether you want to use that information for your own investing. And we always say, go to an expert and get your idea tested out by someone who really is qualified to help you. That's the show. If you want to know more information about us, go to switzerreport.com.au. Thanks for joining us. See you on Monday.